What's up, everybody? Welcome to the live stream. And today we're doing the exam breakdown. And we go through content that's going to help you get through this real estate examination or your mortgage licensing examination. And today is NMLS Day, the Nationwide Mortgage Licensing System. We're doing some exam prep for that particular examination. There are some components that will be beneficial for y'all that are studying for your real estate exam. We are covering a topic known as RESPA, which is a federal consumer protection law, but we're going to be working on that, really drilling down a little bit deeper so we can get to some of the points that are potentially covered on the mortgage licensing examination. My name is D. Kumar. It is a pleasure to be hanging with you. I love going live. I love teaching. I love doing this stuff. It's a lot of fun for me. Happy holidays, by the way, for y'all. And I hope you all are doing well. The goal today is about 45 minutes. I'm going to cover several topics. And as we cover them, I'm going to go through and we sort of do it in a format. The format is I do a little bit of lecture, then I go into some vocabulary, some flashcards, then I go into some quiz questions to wrap up our day. The goal is a quick 45 minutes or so-ish time together where we can power pack this lunchtime and you could be studying on the low. Maybe you're thinking about moving on to another job. Maybe you're thinking about getting into the business. You're sick of your job. You're thinking about figuring something else out. I can assure you that the loan origination business, if done properly, is a very lucrative business, done properly, ethically, morally, and intellectually proper. Then you will be able to do quite well. There are lots of loan originators in the United States, not as many as there are real estate professionals, but the reality is it does not matter how many there are, because if you are excellent at what you do, you'll always be able to do fantastic in the marketplace, regardless of the externalities of competition. Trust me, I know tons of originators, and I know some of the ones that are on the top originators list, they make a killing financially, and they have a pretty decent work-life balance. So if you're looking for a little bit of all of that, the loan origination business might be for you. And for that, let me try to help you get through some exam content to help. Now, if you can, go ahead and comment. It's helpful. If there's things that we can do to help you learn, happy to do it. We just put together a video for another student had a question, and we're about to release that video. We've got some really, really good 2025 content about to be coming out. We're working on it feverishly. The studio is ablaze with content being created everywhere. We will be taking a break next week just to get a little bit of R&R. I want to spend some time with my family and enjoy them, my children, and enjoy the holidays. And I hope to you and yours as well. Without further ado, let's get into it. The topic today is a topic called RESPA. I'm just going to look over my shoulder as I am flying solo in the studio, and I'm in charge of streaming and in charge of everything else that you can't see out of the camera shot. There's a lot of button sliders and thingies that I'm pretty passionate about, but it's just to me to make sure that everything is working. It looks like everything is good. Yeah, let's do this. All right, so let's get into it right away. RESPA is what's on the agenda. The Real Estate Settlement Procedures Act. If you have some comments, comment please. If you are a subscriber, thank you very much for subscribing to our channel. And if you like the live stream, let's keep it up. Just keep telling us stuff, and then we will continue to do what we can to help you guys out with the learning. All right, so the Real Estate Settlement Procedures Act stands for RESPA. RESPA is a consumer protection law, and it is designed to protect home buyers by promoting transparency. That's one of the underlying points here in the real estate settlement process. So with settlements, it's closing, it's loan origination, it's good faith estimates or loan estimates, it's closing disclosures, it's timing, it's accuracy, it's disclosing affiliated business arrangements and those types of things. So that's really what it's about. We found as a society that the settlement process is quite vexing. There's a lot of moving parts. The more transactions you do, the more you simply understand kind of what's happening. But the lawmakers decided that it would be appropriate way back in the 70s. A lot of legislation, by the way, was passed in the 60s and 70s to make it a little bit more transparent, easy to understand, documents that are sort of homogenized to certain processes and all those things. And that's sort of one of the reasons why we have it. Now, with RESPA, you do need to know it is promulgated by Regulation X. So Reg X is RESPA. Reg X is RESPA. So the implementation piece of the Real Estate Settlement Procedures Act is known as Regulation X. For my other students that have taken other courses with me, you know, for example, that Regulation Z is the Truth in Lending Act, and Regulation X is RESPA. So you definitely need to know that combination. You want to know what RESPA stands for also for your exam. I would also know what the initialism stands for. All right, so in the real estate settlement process, prohibiting kickbacks absolutely and referral fees that are unearned, and ensuring borrowers received clear disclosures about the settlement costs and services. There's a lot of professionals that are touching a loan file, that are touching the deed, that are touching the settlement paperwork, and all of these other things. All of them along the way are getting paid for their services, and so it's that sort of black veil that's cast over or covering the settlement provider industry. The point of RESPA is to lift that veil. Okay. The next thing I want to talk about is what is the purpose for RESPA. RESPA's purpose is to protect consumers. It is a consumer protection law from abusive practices in the real estate settlement process. This was enacted in 1974, and I think the dates for the most part on examinations are things that you can kind of downplay. There are some dates, for example, fair housing dates like the Civil Rights Act of 1866. Then we have the Fair Housing Act of 1968. Some of those dates are relevant, and then some just aren't. Now, the enforcer of the Real Estate Settlement Procedures Act, because of something called the Dodd-Frank Wall Street Reform Act, created this thing called the Consumer Financial Protection Bureau, the CFPB. The CFPB has enforcement and regulatory oversight over the Real Estate Settlement Procedures Act, among other laws. Virtually every consumer protection law, by the way, is going to be enforced by the Consumer Financial Protection Bureau. And there's some standouts. For example, HUD still enforces the Fair Housing Act. Now, it applies to residential properties, 1 to 4 family dwellings. This is something that I want you to understand because there are exemptions to RESPA, and there are instances where RESPA does not apply. And we're going to look at those in the upcoming slides to sort of understand that, because I do want you to know the differences here. What are the key objectives? The key objectives of RESPA: to ensure borrowers that they receive information about settlement costs, to eliminate kickbacks. A kickback is, or a referral fee is, if a settlement provider, so let's say you're a real estate agent, you're a consumer, let's pretend, and you're looking at homes, and you say, hey, to your real estate agent, hey, I'd like can you recommend someone to me? They say, yeah, we recommend the same person every time. And let's say that you recommend a real estate attorney or a contract negotiator or a title company or something like that. You're a real estate agent and you make that referral. That's a referral. And sometimes for referrals, if you give business to another professional, well, the other professional might feel that they need to opine and give you some money back in the form of a kickback or a referral fee. Now, kickbacks and referral fees could adversely impact the consumer. Why? So let's say if the attorney typically charges $1,000 for their services, and then all of a sudden, well, they've got to pay you now a referral fee, the real estate agent. So what they do is they say, well, why don't I just charge the consumer $1,200 instead of $1,000, and let the consumer pay the referral fee? Well, there is no benefit that consumer is receiving for the $1,200, for the extra $200, because the service that the attorney is providing is only valued at $1,000, right? So these are unearned fees, and that's how they increase settlement costs. Because typically what has ended up happening is the consumer foots the bill for all of this overbilling, overcharging, and everything else. Now, prior to all these significant changes like the TRID rule and the Consumer Financial Protection Bureau and Dodd-Frank Wall Street, we had an economic crisis. And during all of that time, before the crisis, which was in 2008, when everything sort of economically melted down, primarily because of the mortgage industry, everything was kind of hidden. Even though RESPA was there, RESPA still didn't fully clear and make it transparent to a consumer what settlement charges were. So the new evolution of this stuff really does clarify that. It reduces the cost of settlement services by encouraging market competition. Because what we quote has to be accurate, the most price-conscious, value-driven service providers are going to be able to do well in business. And if you're overpriced, well, now a consumer can compare a title company A to title company B. They can shop around for settlement costs to be able to get the best possible prices. So the idea here with this transparency is the ability to be able to shop. Okay? All right. The next thing, transactions that are covered by RESPA. And then there's some exclusions. And these exclusions are as important as the transactions that are covered. So first off, any federally related mortgage loan. Any federally related loan, which basically means anytime the U.S. government has anything to do with a loan. For example, if a loan is made by a bank, a local community bank, let's say, and they decide to sell it or it's sold to Fannie Mae, the Federal National Mortgage Association, you definitely want to know this for your exam. They might be sold to Freddie Mac, FHLMC, which is the Federal Home Loan Mortgage Corporation, or bundled and sold to Ginnie Mae, the Government National Mortgage Association. These are the secondary mortgage market players. Then if it's going to be intended to be sold there, then it's federally related. If the U.S. government is insuring this in any way, if there's any kind of, HUD insurance, mortgage insurance premium, MIPS, if it's a VA loan, if it's an FHA loan, if it's USDA loan, any of these loans with the intention of selling it downstream to the government or any subsidiary of the U.S. government, it would become federally related. So federally related mortgage loans is a very wide berth of loan packages that are sold, inevitably recreated, and then sort of recapitalized, monetized, and securitized in the secondary mortgage market by the federal government. Purchase loans, refinances, home improvement loans, and equity lines of credit are all covered under the Real Estate Settlement Procedures Act. However, we exclude vacant land, you want to know this, large commercial properties, and temporary financing, things like construction loans and bridge loans and mezzanine loans, many of those of which are not covered under RESPA. So if I were writing a test question, it could be all of the following are covered under RESPA except kind of a question, and that could be very useful. So check your books, check your materials to see if any of those things are listed, and I would just take a note of some of them and then practice those in the form of questions. Which of the following are and are not covered by the Real Estate Settlement Procedures Act? All right. Now, there are several disclosures that are required under the Real Estate Settlement Procedures Act. And for those that joined us last week, we talked about the TRID rule. And I'm just going to briefly write that down here again. It's called the TILA RESPA Integrated Disclosure Rule. And with this, we sort of married disclosures and concepts from the Truth in Lending Act and the Real Estate Settlement Procedures Act. So the T is for the Truth in Lending Act. The R is for RESPA, which is what we're studying today, Integrated Disclosure Rule. And the two primary documents that we created, the two primary ones, are the loan estimate and the closing disclosure. The loan estimate, I would note, needs to be provided within 3 business days of a loan application. And y'all want to know the definition. You can look it up. What are the points? There are 6 of them to have a loan application. Things like social security number, property address, loan amount being sought, income. Those items, once we collect them, it doesn't have to be on a formal loan application. It could be on the back of a piece of paper. If a loan officer scribbles these 6 items down, then technically by law, that has triggered federal disclosure requirements, and it requires that originator to give a loan estimate within 3 business days. Another thing that I want you to look up is what are business days, and what are business days opening a loan compared to what are business days and rescission days at the settlement point. Those are a little bit different. Because you'll find for loan estimate disclosure, if the bank is open consistently on a Sunday, well, Sunday is considered a business day to that bank then. And a lot of banks, local banks, are open on Sundays these days just to help accommodate their consumer base. Now, the loan estimate will reflect and discuss the settlement costs that you see typically inside of the loan transaction. Things like title charges, things like loan origination fees, application fees, all of these different charges that go into consummation of a loan transaction. That's what the loan estimate will estimate. Now, this estimate has to be pretty accurate. It's not like a contractor's estimate, which is very subject to change. It's got to be something that's very accurate and doesn't change. As a matter of fact, what the loan originator decides to charge cannot change at all. So there are changed circumstances, and I would recommend looking those up. Look up changed circumstances as to when these documents can be redisclosed legally. The closing disclosure is just a sort of recapitulation of the loan estimate, a restatement of it, and it's delivered at least 3 business days before the closing or settlement. And it talks about basically the final numbers. And the loan estimate and the closing disclosures have to be very, very close in what they were originally disclosed and what they've completed. As a matter of fact, there is a closing that is done in good faith, where let's say if the charges overall as an aggregate are cheaper at closing than they were initially disclosed. And then there's also doing a loan in bad faith, where the charges came in higher and we didn't redisclose to the consumer, and the consumer was confused about why things came in higher. See, back in the day, before all of these changes, things would just get hot, like things would just come back. Like the title attorney might say, hey, look, instead of charging $2,500, I'm going to charge $3,200. We had to do some sort of, clear some title issues and defects, etc. And we're going to charge them $3,200. And then at the settlement, all of a sudden the consumer's looking at it and it was, well, you told me it was $2,500. Oh, I'm sorry, things changed. It's $3,200. And if you don't sign the papers, you've got a buyer waiting, if you're the seller, waiting for your funds. The buyer's waiting for keys in a moving truck, and you've got this calamity. So really, for a few $100s here or there, consumers would just sign on the dotted line and not fight about it. We also have a 3-day right of rescission for my mortgage students that you're going to learn about in refinance transactions, and you have 3 full business days to be able to handle that as well. Servicing disclosure statements is another statement. It notifies the borrower if their loan servicer. The servicer is the party that collects the mortgage payment, pays the owner of the loan their part, and then also handles the taxes, collections, foreclosures, and everything else. If you have an existing mortgage, as a matter of fact, then you are cutting your check to the servicer of the loan. The servicer could also be the owner of a loan, but many times the servicers are servicing a loan pool, and it's for owners of, and they're collecting for the owners of the loan. So just so you know. There is an initial and annual escrow statement, and it details the escrow activities. By escrow, I mean the bank will collect in advance the 1/12 every month of the yearly tax bill and make the disbursements as required by the government, the local government, the local jurisdiction. And then they'll also many times collect insurance payments for the homeowner's insurance or hazard insurance or peril in addition. So those are your initial, when we're setting up the escrow, when we're closing, and then every year thereafter, there's going to be a statement that comes out that says, hey, there's a shortage in your escrow account, you need to pay this much, or there's this and you need to fix this, and you go from there. And then the final thing here is something known as an AFBA, an affiliated business disclosure. It's required if you are referring business. You see, there's nothing wrong with sharing business and referrals. However, it needs to be disclosed that those two entities do have an affiliated business arrangement and that they might be offering bundled services which could be cheaper to the consumer. So the regulators aren't opposed to AFBAs, affiliated business arrangements. If, in fact, it is a benefit to the consumer, then they're all for it. But if it's to just hide a referral fee or a kickback and to inflate the fees, that's when regulators say you're in violation of RESPA. All right, so far, so good. There are a couple of sections on RESPA that we need to be familiar with, and these are Section 8, Section 9, and Section 10 of RESPA. These are sections inside of the Real Estate Settlement Procedures Act that address specific things. Section 8 violations are the anti-kickback rules. So we were talking about kickbacks. You will find information about the kickbacks and the anti-kickback provisions inside of Section 8. So I want all of you to note that Section 8 is kickbacks, right? Section 8 is kickbacks. Again, prohibits receiving or giving anything of value for referrals. Now, anything of value is very, very, very open to interpretation. And so technically speaking, if a title company shouldn't give a mortgage company mugs and this and that. That's looking at it to the very, very letter. So obviously we know that title companies will give mortgage companies, products. Hey, here's a bunch of like merch, just to remember our name, marketing pieces. So many times, as long as it isn't significantly overpriced, etc., then it flies. But then there was a case where there was a large title company that was found in violation of RESPA and ordered to pay $24 million. What they were doing is they were giving a computer to every mortgage company if the mortgage company was going to order title services through that huge company, which lots of them did. Then if they here use our computer, which has our portal built into it, so you have our computer, you can go directly to it. So they retrofitted each mortgage office across the country with these fancy computers, and then the regulator said, well, how is that not a kickback? You're giving them these awesome computers to be able to order title services. That's absolutely a kickback. And then they were ordered to pay $24 million because of that. So even the biggest title companies with attorneys whose uncles and aunts are attorneys mess this up, walk a fine line, get checked all the time, even in modern day, for violating RESPA Section 8. Now, the penalties: fines up to $10,000 and up to 1 year in prison. You definitely want to know the penalties. And these settlement service providers are things like title companies, real estate agents, and lenders. That was Section 8. Just an overview. Section 9 of RESPA deals with title insurance restrictions. And in certain states, you will see that the seller has to purchase title insurance for the property. And in some states, they don't. Like here in where we're streaming this from in Massachusetts, we don't have to do that as a seller. The buyer typically will buy the title insurance when they're purchasing the home. But we don't have to do that, right? It's for sellers. So, but in some states, they do. So here with RESPA Section 9, we've got sellers cannot require buyers to use a specific title insurance company. Violations allow buyers to sue up for 3 times the damages of the cost of the title insurance. So many times the seller can say, hey, use my title company because it could be cheaper, use my title company because they're covering us, etc. The buyer in those states has the absolute right to purchase title insurance from any provider or carrier that they wish to work with. And if the seller requires a buyer as a contingency to buy their home, only if they use that particular title company, then that could be a violation of Section 9. Very small. Really, if you're looking for high value, I would say memorize Section 8, which is the anti-kickback provision. Much better to memorize. Section 9 could be a possibility, but I would say it's probably lower than Section 8. Section 10 of RESPA deals with escrow account regulations. Remember earlier we were talking about initial and annual escrow accounts. So when we close, there's an initial, and then every year there's an annual escrow statement. Okay, and the limits on how much a lender can require in escrow, very specific limits. Typically, it's no more than 3 times the payment, the monthly payment of taxes and insurance, plus $50. All right, so you want to know the threshold. 3 times the payment plus $50, and an escrow can't be overcompensated or overfunded. All right, the annual escrow statement is always required, and also if the consumer's taxes or insurance premiums drop, not like that's been happening lately, but if they drop, then the bank has to do the accounting, and then they have to promptly refund the borrower for those overpayments. So you want to know how much. It can be at maximum held in an escrow account. That's always helpful. You'll find that data inside of RESPA, inside of Section 10 studies in your books and materials, and you'll find it there. Not a big deal. I would memorize it just to know. So Section 10, down, done. Who enforces the Real Estate Settlement Procedures Act? Again, it's enforced by and administered by the CFPB, the Consumer Financial Protection Bureau, the Dodd-Frank Wall Street Reform Act, which the mortgage folks definitely need to know about. Dodd-Frank. There's 2 sections of Dodd-Frank, as a matter of fact. Dodd-Frank Section 10 and Dodd-Frank Section 14. All right, like those are the two big ones for your mortgage exam. There's a lot of other sections, but it's not appropriate or not applicable to the mortgage folks. The Dodd-Frank Act, Section 10, created the Consumer Financial Protection Bureau. Okay, and so they have enforcement authority and administer the Real Estate Settlement Procedures Act. Violations can be fines, imprisonment, as we saw with RESPA Section 8 violations, and civil liability, damages and legal fees. Messing with RESPA Section 8 could basically bankrupt a title company, could bankrupt a mortgage company, could bankrupt lots. And lots of companies have been taken out because of that. The local authorities, the Division of Banks, the Division of Insurance Corporations, all the ones in the states can pass off the authority in enforcement to the federal government, or they can utilize their own enforcement authority as well. Okay? All right, that's the enforcement and penalties. Let's do some key points, and then let's take a short break, and then let's get back into some vocab. First off, the point that we want to know is the purpose of RESPA. It protects consumers from unfair practices in real estate transactions. The disclosures that we briefly discussed here during this segment was loan estimates, closing disclosures. Remember, loan estimates 3 days from the time of loan application, closing disclosures 3 days from the date of consummation. So 3, that's pretty easy to remember. Servicing disclosures. By the way, you also want to know what are changed circumstances, what are the typical fees found on these documents, what about redisclosure? What about clerical errors, like mistakes on the closing disclosure? Within how many days do we have to rectify that? Within how many days do we have to fix other issues? You want to know those. You'll find those inside of the TRID section in your materials, wherever you're studying them from. That's stuttering, buddy. All right, so disclosure requirements, servicing disclosures, affiliated business arrangements, and escrow statements. We talked briefly about all of those. Prohibited practices, no kickbacks or referral fees, unreasonable escrow charges, and mandatory title insurance providers. No kickbacks and referral fees, that was Section 8. Unreasonable escrow charges and escrow, what they can charge, that was Section 10. And then mandatory title insurance providers, that was Section 9 of RESPA. And we covered those right here. Enforcements administered by CFPB with penalties including fines, imprisonment, and civil liability. And then the impacts for the mortgage loan originators, MLO stands for mortgage loan originators, is compliance ensures ethical practice, builds client trust, and avoids severe penalties. I can just assure you that if you do business ethically, honestly, and professionally, and you learn with the right sort of mentorship as you're getting into the business, all of this foolery you will not need to be able to have a lucrative career in mortgage originations. All right, so let us take a short break here as I get the slides for our vocab, and then we'll do the vocab phrases. We'll cover those. I'll give you my 2 cents there, and then we're going to get into some questions, and then we're going to wrap our session. So just a short break. I'll see you in a few. You guys are doing fantastic. I hope this is helpful in some way. I love going live. Thank you guys very much for checking it out. Don't worry if you're missing this. We'll always repost these later so you can watch them at your convenience. We'll see you in a few minutes. All right, we are back. Let's do some vocab here, and I want to cover some of these flashcards. So let's get into them, and they should be helpful as you're studying for the Real Estate Settlement Procedures Act. And we'll look at some of these and talk about them a little bit more. So the first one is RESPA. RESPA stands for the Real Estate Settlement Procedures Act. It's a federal law designed to promote transparency and fairness in residential real estate settlement practices. Loan estimate. The loan estimate is a disclosure provided within 3 business days of a loan application, detailing the estimated loan terms and settlement costs. Remember, find the definition for what a loan application is for your exam. Closing disclosure. A closing disclosure is a document given to borrowers at least 3 business days before closing that outlines the final loan terms and settlement costs. Servicing disclosure statement. This disclosure is informing the borrower whether their loan servicing may be transferred to another company, among other things. Kickbacks. Kickbacks are payments or favors given in exchange for the referral of settlement service business. Note, RESPA prohibits the exchange of kickbacks, fees, or anything of value in exchange for referral related or to federally related mortgage loans. Escrow account. An escrow account is a bank account used by lenders to hold funds for property taxes, homeowners insurance, and other related expenses. Affiliated business arrangement disclosure. An AFBA is a document required when a referral is made to a business with a financial relationship to the referring party. Section 8. Section 8 is the RESPA provision that prohibits kickbacks, referral fees, and unearned fees in real estate transactions. Section 9. Section 9 is the RESPA provision that prohibits sellers from requiring buyers to use a specific title insurance company. Section 10. Section 10 is the RESPA provision that regulates escrow account limits and requires annual escrow statements. Federally related mortgage loan is a loan secured by a first or subordinate lien on residential real property covered under RESPA. And remember, we talked about these loans and the intention to be sold on a secondary mortgage market insured by the federal government or purchased by the federal government. Title insurance is a policy protecting the lenders and homeowners against losses from disputes over property ownership. Remember, according to RESPA Section 9, a seller cannot force a buyer to purchase title insurance from a required provider according to the seller. Unreasonable escrow charges. Excessive amounts required by lenders for escrow accounts prohibited under RESPA, Section 10, by the way. Consumer Financial Protection Bureau, CFPB. The federal agency responsible for enforcing RESPA and other consumer protection laws. Remember, created under Section 10 of the Dodd-Frank Wall Street Reform Act. Annual escrow statement. A yearly document that details the activity of an escrow account required under RESPA. Settlement services. Services provided during the mortgage process, including title searches, appraisals, and loan origination. All right, those were some vocab phrases. Again, sort of a review of everything that we talked about earlier as well. Let's take another short one while I get the questions, and we'll get some questions in. I think we have like 5, and then we'll wrap the session. See you in just a few minutes. All right, we're back. Let's do it. All right, we got some questions coming at you. Let's do these questions. There's a few, let's say 5 questions, and let's start in right here with question number 1. Which of the following practices is prohibited under Section 8 of RESPA? Letter A, charging reasonable escrow fees. Letter B, requiring title insurance. Letter C, paying kickbacks for referrals. Letter D, failing to provide a loan estimate within 3 days. Which of the following practices is prohibited under Section 8 of RESPA? And the answer? Letter C, paying kickbacks for referrals. Okay, remember, with RESPA Section 8 specifically, we are dealing with kickbacks. So anything with kickbacks is Section 8 of RESPA. Keep that one in mind. Question number 2. A seller requires a buyer to use a specific title insurance company as a condition of the sale. The buyer agrees but later learns about RESPA's rules. What action can the buyer take? Letter A, file a lawsuit for 3 times the cost of the title insurance. Letter B, report the seller to the CFPB, which will revoke the title insurance. Letter C, reopen the sales contract with a new title company. Letter D, request a refund of the title insurance premium. A seller requires a buyer to use a specific title insurance company as a condition of the sale. The buyer agrees but later learns about RESPA's rules. What action can the buyer take? And the answer? Letter A, file a lawsuit for 3 times the cost of the title insurance. So we learned earlier that a violation of Section 9 of RESPA would allow a consumer to potentially collect 3 times the amount because the title insurance company was required as a condition to the sale. Question number 3. What is a requirement under Section 10 of RESPA regarding escrow accounts? Letter A, lenders can require unlimited escrow deposits. Letter B, annual escrow account statements must be provided to borrowers. Letter C, escrow accounts are optional for federally related mortgage loans. Letter D, escrow accounts can only hold funds for property taxes. What is a requirement under Section 10 of RESPA regarding escrow accounts? And the answer? Letter B, annual escrow account statements must be provided to the borrower. Again, remember, with Section 10, it's all about escrow and servicing. We're learning about the different components of what RESPA requires, and Section 10 is all about escrow accounts. Don't forget, you want to know about how much money can be, the maximum can be held inside of escrow. I mentioned 3 payments plus $50, that kind of stuff. You want to know that, and this annual escrow statement, absolutely. Question number 4. When must a loan estimate be provided to a borrower? Letter A, at the time of closing. Letter B, within 3 business days of loan application. Letter C, at the time of loan approval. Letter D, before the first payment is due. When must a loan estimate be provided to a borrower? And the answer? Letter B, within 3 business days of loan application. Loan estimates and timing, 3 days from an application. Learn the definition of an application, the points of what is contained in an application. And then for closing disclosures, you want to remember it's within 3 days of the consummation of the transaction. So that's pretty easy to remember. Learn what is a business day on the front side and what is a business day on the back side as well towards closing. The final one here, question number 5. Which of the following is true about an affiliated business arrangement, an AFBA, disclosure under RESPA? Letter A, it is required when a settlement service provider refers a borrower to a business in which they have an ownership interest. Letter B, it allows service providers to receive referral fees as long as they disclose the arrangement. Letter C, it is optional if the referred business is not directly related to the mortgage process. Letter D, it replaces the need for a closing disclosure if issued on time. Which of the following is true about an affiliated business arrangement disclosure under RESPA? And the answer? Letter A, it is required when a settlement service provider refers a borrower to a business in which they have an ownership interest. We definitely want to know about the affiliated business arrangements in RESPA, and remember, it's a Section 8 violation. All right, so hopefully this was helpful. Now you know what you maybe didn't know before, and now that you know something, you can't unknow it, right? So good luck with your studies. Good luck on your exams. Have a really, really awesome holiday season. You know, work hard if you can, but get a little bit of family time if you can. Also, that's always good for us. And enjoy it if nothing else, okay? Thank you very much for subscribing to our channel. Things are growing and growing and growing, and we owe it all to you. So we really appreciate you. Happy holidays. We'll see you in the next one. And I believe we're taking a break next week, but we'll be back the following week to get things going. So good luck until then. We'll see you. We'll see you on the other side of this. Hope you pass your exams and hope you do well. Thanks again for watching. We'll see you soon.